What does it actually take for a high-income family to build real wealth? Because let's be honest, earning a lot of money doesn't automatically make you wealthy. In fact, I've seen families double their income and barely move the needle on their net worth. And these aren't irresponsible people. They're smart, they're driven, they're earning $300,000 to $400,000, sometimes more. But somehow progress feels slower than it should. So today, I'm going to show you the exact behavioral framework I use with high-income families to transform strong income into lasting wealth. Because if you don't fix the structure, lifestyle expansion quickly absorbs the margin. Raises feel big, but your savings rate barely moves. Bonuses hit the account, then disappear into normal life. And while years go by, you're wondering why your net worth doesn't reflect your paycheck. In this video, I'll show you why high income alone doesn't translate into real wealth. The 4-step behavioral framework that removes the friction holding you back. And the exact action steps you can implement this month to start saving and investing more efficiently. Now, before we get into the 4 steps, let me tell you about a family I worked with a few years ago. They were earning well into the 6 figures. Great career, young kids, plenty of income. And they told me, Daniel, we've tried saving for college before. We just never seemed to make traction. They weren't overspending, they weren't doing anything reckless, they just didn't have a structure for building wealth. Every month they would say, we'll move some money into the 529. Sometimes they did, sometimes they didn't. Sometimes it felt like too much, sometimes something else came up. So we automated it. We set up a fixed monthly contribution into their kids' college accounts. It ran automatically, just like their mortgage. Same income, same expenses, same goals. But now it wasn't a decision anymore. There was no guessing on how much to put in, no debating the timing, no emotional negotiation at the end of the month. It just happened. And within a year, they had made more progress than they had in the previous 3 years. Nothing about their intelligence changed. Nothing about the market changed. Their income didn't suddenly spike. The structure changed, and that changed everything. Now, here's the bigger pattern. That family situation isn't unique. I see this over and over again with high-income earners who come to work with me. Income goes up, lifestyle goes up, but the saving rate, it barely moves. According to research, many high earners don't increase their saving proportionally as income rises. Not because they can't, because when income is high, saving feels optional. And studies show that higher income households tend to mentally label income as flexible, which leads to more discretionary leakage. In other words, the more you make, the more it feels like you have room to decide later. And here's the trap. If saving requires a decision every single month, it will eventually lose to everything else competing for your attention. Career, kids, travel, home projects, life. The biggest inefficiency I see with high-income families isn't bad investments. It's friction. Small behavioral leaks that compound quietly for years. So let's fix this structure. Here's the 4-step behavioral efficiency framework I use with my clients. Step 1, create a forced saving architecture. I've never met a high-income family that lacked intention. I've met plenty who lacked automation. Here's what typically happens. You mean to invest what's left over at the end of the month. You mean to transfer money into your brokerage account. You mean to increase your 401k next year. But saving sits at the bottom of the priority list because it feels adjustable. And if it's adjustable, it's also vulnerable. Behavioral finance research shows that when people pre-commit future raises to retirement savings, contribution rates climb dramatically over time. Automatic enrollment in 401k plans pushed participation rates from roughly 60% to over 90% in many employer plans. Why? Because automation removes the need for motivation. High-income professionals operate in decision fatigue. You're making leadership decisions all day at work, strategic calls, hiring decisions, business development. Then you go home to make parenting decisions, helping with homework, driving to football and volleyball practice, planning a date night with your spouse. If saving requires discipline at the end of the day, it will eventually fail. If it requires no decision at all, it becomes permanent. So here's what this looks like practically. First, max out retirement account contributions. Automate brokerage contributions and invest monthly. Automate 529 contributions. Set calendar reminders each year to increase savings with raises. Treat your saving like a mortgage payment, non-negotiable, invisible, structural. But automation alone isn't enough, because I've seen high earners automate contributions and still lose years of growth for one simple reason. Step 2, eliminate idle capital. I once had a client come to me who had been investing for years. They had an automatic draft set up into their brokerage account every single month. Money was leaving their checking account like clockwork. On paper, it looked disciplined. But when we logged into their account, the money was just sitting there in cash for years. They had automated the transfer, but never turned on automatic investing. So the contributions piled up in a cash account, earning next to nothing while the market moved on without them. Now, in this case, the issue wasn't fear. It wasn't market timing. It wasn't even a strategic decision to hold cash. It was simply incomplete automation. The transfer was automated, the investment was not. And here's why this matters beyond just one story. Even when it starts as an accident, cash sitting idle tends to stay idle, because once money is in cash, it feels safe, it feels flexible, it feels like optionality. Here's the catch. Over long periods of time, excess cash allocation quietly drags down returns. JP Morgan has shown that missing just a handful of the best market days over a couple decades can dramatically reduce total returns. And investors sitting in cash often miss those recovery periods because they're waiting for clarity or the perfect time. And this is loss aversion at work. We prefer the comfort of idle security over invested uncertainty, even when the long-term math clearly favors investing. So let's draw a clean line. Your emergency fund, that's intentional liquidity. Excess cash sitting in a brokerage account, checking, or after an RSU sale with no plan, that's unintentional underperformance. Idle cash feels safe, but over 10, 15, 20 years, it quietly guarantees lower wealth. So here's what you do. Audit every investment account you have. Your 401k, your brokerage accounts, even your equity compensation accounts. Turn on automatic investments for new contributions. Set a deployment rule for bonuses or RSU sales before they hit your checking account. Keep a defined emergency fund and invest the rest with intention. Automation gets money moving, but if that money isn't actually invested, the system breaks. And here's another leak that shows up almost every time income increases. Step 3, pre-commit raises and bonuses before they hit. Raises are when wealth is built or permanently delayed. I can't tell you how many times I've seen this play out. Someone gets a $25,000 raise or a $60,000 bonus. For a moment, it feels like a breakthrough year. And 6 months later, nothing structurally has changed. We adjust incredibly fast to higher income. What felt like a windfall in January feels normal in June. And if there's no plan in place before the money hits the account, you end up negotiating with your emotions. Research showed that when employees commit future raises to higher retirement contributions, saving rates climbed from around 3 to 4% to over 13%. Not because they suddenly became more disciplined, but because they decided in advance. That's the shift. You don't decide what to do with the bonus after it arrives. You decide before it arrives. So here's what that looks like practically. Increase your 401k contributions every time you receive a raise or change jobs. If you're not maxing it out yet, redirect a fixed percentage of every raise automatically. Create a written bonus allocation policy before bonus season. For example, 40% of the bonus could go to long-term investing. 30% could be reserved for taxes. 20% towards a specific lifestyle goal. 10% go towards giving or something meaningful. And that's how high income quietly turns into huge savings without friction. Now, there's one final area where I see high earners slow themselves down, ironically, trying too hard. Step 4, simplify the investment engine. I don't see high income families fall behind because they're under diversified. I see them fall behind because they're overcomplicated. Here's what happens. You start reading, you're listening to podcasts, you hear about factor tilts, alternatives, private deals, tactical shifts, tax overlays, and market timing strategies. And instead of investing consistently, you start trying to optimize everything. You tweak, you rebalance, you add another fund, you take one away, you wait for a better entry point. 3 years later, you're still refining your portfolio. Meanwhile, broad market index funds just keep compounding. Spiva reports consistently shows that most actively managed funds underperform broad indices over long periods. And there's another behavioral trap here: choice overload. When you're presented with too many options, the most common response isn't better decision making, it's inaction. Vanguard's research shows that investor behavior, not small differences in allocation, is one of the biggest drivers of long-term performance gaps. So here's the principle. Wealth is built by consistency, not complexity. You don't need the perfect portfolio. For most high-income families in their 30s and 40s, that means broad market exposure, low-cost index funds, and a stock-to-bond allocation appropriate for your time horizon. For most people, that's an 80% stock and 20% bond mix at minimum. Many of my clients, they're closer to the 90 to 95% stock because they have decades ahead of them and high income to weather volatility. Now, make sure you're rebalancing occasionally, then leave it alone. Simple, boring, efficient. And when you combine this with automation, eliminating of idle cash, and pre-committed raises, you remove the friction. You eliminate the 1% leaks, and here's what most high-income families don't realize. And if you want to see how this fits into a full tax-first wealth plan, you have to look at the other side of the equation. Because for high-income earners making $250,000, $350,000, $500,000 a year, the real issue, it's how much of every additional dollar you actually keep. And at that income level, your marginal federal tax rate is often 32% to 37%. Add state tax, especially in major metro areas, and you're frequently looking at a combined 40% to 50% marginal tax rate. And then bonuses and RSUs come into play, and the withholdings there often don't match your actual liability. Then what happens? You either overwithhold and give the government an interest-free loan, or you underwithhold and write the painful check later. Neither is efficient. And here's the leverage most people miss. Every dollar of tax saved at your income level isn't small. If you reduce taxes by $10,000 and invest at 7% for 20 years, that's nearly $39,000. That's not a rounding error, that's compounding. So in the next video, reducing taxes on your high salary, I'm going to walk you through the two buckets that matter most: how to reduce taxes today and how to reduce taxes over your lifetime. Because building wealth efficiently isn't just about saving and investing more, it's about keeping more of what you earn in the first place. Click right here and let's tighten up the tax side of the system.